Welcome to the Finance Podcast. The topic of this episode, Trump, geopolitics and macroeconomics, how have miners been performing? With Mark Burridge from Baker Steel Capital Managers.
Okay, I think it's time. Ready to go? Hello everybody, welcome and thanks for coming to listening to me. So I was a bit disappointed when I came in a few minutes ago because there was a very interested looking investor and she asked me, is this about crypto mining? And I said, no, it's about real mining where we dig rocks and out of the ground. And she left before I could even tell her actually that cryptocurrency really depends on real mining. You can't have data centers and IT infrastructure without critical metals and minerals ranging from copper to rare earths to silver. So unfortunately she'd left before I could give her that story and she's probably next door listening to something else. But no, I'm really glad to be here to talk about real mining, but real mining actually has, important role to play in future-facing technologies, and we'll talk about that during this presentation. Now, the title of the presentation is Trump, Geopolitics and Macroeconomics. Obviously, we're in very uncertain times right now. Today's a big day. It's Liberation Day or Tariff Day, depending on how you want to talk about it. So everything I say now may be completely changed by later on this evening, but we'll go with it. We're trying to position our portfolios to manage this, and so far we've done that very well. So a little bit about us. Introduction, we'll talk about Trump, macroeconomics, geopolitics. We'll talk about this fantastic new bull market for precious metals and why it's so profound right now. We'll talk about mining company equity valuations, what will cause them to re-rate up to where metal prices are. And then we'll talk a little bit about how we take advantage as investment managers of this environment to make money for our investors. We're going to standing room only. I'll turn the volume up. There's some people outside who might want to listen in. So a bit about us, Baker Steel. We are a boutique asset management firm. We're independently owned and operated. We have assets of about $1.2 billion and offices in the UK and Australia. Well, we're recognized in the space. We run two main strategies. Our Electrum Fund, which is about future-facing metals, and our Precious Metals Fund, which, as you'd expect, invests in the equities of mining companies involved in precious metals. We also have a couple of smaller strategies on the slide, but really this presentation is going to focus on about our Precious Metals Fund and our Electrum strategies. We've won a number of awards over the years because of our good performance, and that good performance is built on the team. Now, we probably have the deepest, broadest team in the sector. We've got geologists, metallurgists, accountants, economists, social scientists across the team. Collectively, we've got almost 200 years of multi-cycle sector experience, not just as fund managers, but as company executives, as geologists, as miners. In fact, that's how I started off. I started off as a geologist working in Southern Africa, Latin America, North America, before I moved into the financial side of things. Now, a little bit about performance. So this has been a very mixed sector over the last year. Some elements have done brilliantly. Precious metals. You can see that gold was over the last trailing 12 months, gold was up 40%. Gold equities were up 56%. Our gold equities fund was up 60%. But you can see it was a bit more of a mixed story for other metals. You can see that battery metals in particular, nickel and lithium, were down 15 to 25%. Iron ore was down 14%. Copper showed some reasonable gains. But despite the fact most of the metals and mining sector was down double digits, our Electrum fund, which invests in that sector, was up 19%. And I make that point up front because we do have a unique approach for stock picking and subsector allocation that enables us to generate some kind of performance even when the broader market is down. So not only do we do well when the market is rising, but we can also do well when the market is flat to down. I'm going to talk about performance, not with like a chart. You guys can all look at charts on Morningstar or whatever you use to our performance. But what I've done here is to show that this is a sector that is so tricky to invest in. Most people think that it's a speculative sector where you have to take on a huge amount of risk in order to generate returns by betting in wildcat drilling companies or speculative jurisdictions. But we actually reckon that managing risk rather than looking for stocks that are cheap, is the best way to generate returns. And we have done that over the years, and this is what we try to do. So what you can see on these charts, we've plotted a measure of risk here, volatility on the lower axis, and returns on the vertical axis. What you can see is our funds, both precious metals and Electrum, generate positive return relative to their benchmark indices in the broader sector, but without taking on more volatility or more risk. And that's really important because investing in this sector has a lot of pitfalls. So managing that risk, not just looking for value, are key. And I'll talk more about our investment process later on. So why are we so excited about this sector? Why have we built this big team that you saw a few slides ago? Well, that's because we're in the middle of major global changes going on right now. We have a macroeconomic and geopolitical sea change going on right now. Right now it's dominated by Trump, trade confrontation and supply chain issues. But we also, that's against the backdrop of broader economic imbalances, high levels of debt and high levels of interest rates. And we have ongoing conflict and geopolitical tension going on right now. So typically, that's an environment that's positive for gold, but also it's an environment that has important implications for industrial metals in terms of supply chains and supply security. So that creates risks and opportunities for investing in the broader metals and mining sector, not just precious metals. At the same time, we're going through a new industrial revolution. Now, we've all talked about net zero, the expansion of renewable energy, green transportation, but now the growth of AI and other new technologies in aerospace, for example. And on top of that, we've got Trump trying to generate pro-industrial growth in the US and China looking at generating stimulus to generate growth there. So we have a backdrop where there are a lot of interesting drivers for metals and mining stocks, generally positive, and at the same time, the opportunity in mining equities has never been better. The stocks are undervalued, they've got robust financials, and they're exercising better financial discipline than they have ever done in the last 30 or 40 years. So we've got a sector where the macro drivers are positive and the companies are in really good shape. So let's look at some charts that maybe underscore that in a simplistic way, why we're so positive about the sector. So first of all, let's look at the gold bull market that we're in. I'll talk about the gold bull market a bit later on, but here we can see is that relative to historic gold bull markets, we're just part of the way up that curve. So that chart just simplistically suggests to us that there might be more to come, and there's lots of good reasons for that I'll talk about later. But looking at broader commodities, look where we are in broader commodities. Commodities are essential for the net zero transition. They're essential for AI data centers. They're essential for aerospace and defense. But yet, trading at near all-time lows relative to broader financial markets. So that underscores what an opportunity there is in the sector right now. Let's look at some measures of value. Here we can let's look at EV/EBITDAs and margins for the mining sector and the precious metals and mining sector on the left-hand chart. I would use the laser pointer, but it's not working, so you'll have to sort of pick through that. We're trading on much lower EV/EBITDA multiples, despite having better margins. Now, the argument say, well, there's no growth, there's no yield. Well, hang on a sec, there is yield. If you look at some of these companies, there's 3, 4, 5, 6% dividend yield on some of these metals and mining companies. And yes, there is growth, selectively in the precious metal space, but there's huge growth in demand growth in copper, in lithium, in other key industrial metals. So there's a lot of top-line growth as well as margin expansion going on in these mining companies. So the growth yield argument also is you've got growth yield in value in many of these stocks. Another way of looking how undervalued this sector is to look at the Magnificent Seven average market cap is bigger. So the average market cap of one Magnificent Seven is bigger than the market cap of the entire mining sector. Okay, this is quite profound. So a bad day for the Magnificent Seven is probably the entire battery metal and future-facing metal sector put together. And I think there's a disjoin there. The question, of course, is when does that disjoin get rectified? And just as a final thought on value, we actually do have, in our evaluation tools, we track fundamental value of these mining stocks. We can see that actually, well, at yesterday's gold price, it was the stocks were trading at less than 50% of their underlying fundamental value. And probably at tomorrow's gold price, it's more like a third of their underlying fundamental value. using our tools. And what we can see is that our portfolio is positioned on relatively better valued stocks. But another important thing about not just gold, the metal, but also the mining equities, they provide a really important diversifier to portfolios. Here you can look at gold and precious metals equities as a really important diversifier relative to the S&P 500, and you compare that to Bitcoin, for example, which really doesn't provide that much diversification historically. So it's really interesting asset class. There's a bit of M&A going on in the sector. It's an important driver in gold, copper, and in lithium and other metals. I'll talk about that at the end if anybody wants in the Q&A. So what are these trends and what do they mean for metals mining? Will Trump, we had a little thought piece a couple of months ago say, will Trump and China make mining great again? Well, they've certainly made gold great again, and let's see if they'll make mining great again. So just some statistics there. So this is the backdrop here, okay? This is demand growth for selected metals based on just energy transition to net zero. What you can see, we've got double-digit demand growth happening across a wide range of commodities, ranging from prehistoric commodities like copper to new commodities like lithium, and this is just for net zero, let alone other future technologies. And what we can see is that AI data centers consume the growth in metal use in data centers. Just taking another example, is very significant across a wide range of metals, ranging from again copper to silver and gold to rare earths. So it's a really interesting, big, new industrial revolution going on here, which needs a lot of these metals. At the same time, we're seeing, because of the supply side discipline we're seeing, we project supply-demand deficits opening up in almost all of these key metals over the next few years. Even metals like nickel, cobalt, and lithium, which are in supply-demand balance or slight oversupply right now, in a few years' time, without new projects, these metals are going to be in supply-demand deficit. I'll move on to the next slide for the sake of time. We can talk about that in more detail. So, will Trump make mining great? What some policies? So there's some. So I sort of put Trump's policies in three key baskets: energy, industrial growth, and infrastructure. Make America great again. So will downward pressure on energy prices eventuate from this? Will the boost for nuclear and selective renewable energy happen as a result of this? Will there be large-scale infrastructure and housing investment? Will there be encouragement of investment in industrial growth in the US? Obviously, that's positive across a broad range of metals. There is a question mark around battery metals and renewable energy because of Trump's policies. But if one of the world's largest EV manufacturers is a big supporter of Trump, you don't see him completely going against the concept of EVs. Although I wouldn't want to own a Tesla right now. And then trade policy and geopolitics. Well, what can you say? Every single morning we wake up with a new tweet or a new trade policy or whatever. But it's quite profound because it's interesting, because what it does is it perhaps rectifies some distortions but creates some new distortions. Will there be a negative impact on global growth, as a lot of people are thinking about actually increasing their risk perception of a potential downturn because of this trade war? But will it provide a stimulus for encourage US industrial domestic growth? So there's a question there, which of course would be positive for metals. Of course, all of these things are positive for gold, but some of them may or may not be positive for other metals. And then inflation and monetary policy. I think we're in an environment where, real interest rates have risen and the expectation for rate cuts has diminished, yet there is pressure, political pressure, to keep real rates lower because of the impact both on national and individual balance sheets. So I think our view is that in the medium to long term, there's a real opportunity for Trump policies to at least make mining great again in America, even though there might be some fallout for other parts of the world. And of course, we manage that in terms of our portfolio management. I'm not going to go through the tariff table. is probably already out of date, even though we produced it 2 weeks ago, and it will definitely be out of date in 12 hours' time. So I'm just going to leave this alone. But it's just, we track it because it has profound implications for the stocks we invest in. I'll talk a little bit in our investment approach how we take advantage of those things. So a little bit about China and US growth, because metals and mining used to be about US industrial growth and a little bit of German and Japanese industrial growth. Those used to be, when I started off in this business, that's what you looked for. You looked for US growth and to a lesser extent Japanese and German growth as the drivers of metals and mining demand. That picture has fundamentally changed over the last generation. And now China is the dominant force in metals and mining demand. Metals and mining company share prices and metals and mining prices rise and fall based on Chinese policy announcements around stimulus or economic growth. So the question is, will Trump policies let US industrial growth rise again? Clearly that's an intention. He's looking to promote future-facing industries such as AI, aerospace, and defense, and he's looking to promote traditional industries such as steel making. So there's a really interesting historic analogy here, but that perhaps there's a mean reversion here. China still remains strong and growing, but US catches back up to where it was. And of course, the US relies on imports of critical metals across the board. So there's a big supply chain question here. Will the US create domestic supply chains or more friendly supply chains for some of these metals and minerals? This is a brilliant environment for us as investors because it creates a huge range of opportunities for us to invest in, to take advantage of both what is happening in the US and in China. And now Europe, I'll talk about that later. So look, both the US and China face issues. And I think people may or may not agree with Trump's approach to fixing these issues. Certainly right now they're looking a little bit shaky. But the reality is the US is got a huge deficit. China's deficit is forecast to grow. And both countries have social issues that they need to address. Both countries have decided to go double down on growth as a way of getting out this problem. So the European model has been, let's tax more, let's borrow more, let's spread the declining wealth out more. Whereas I think here what we've come at is both these countries are committed to doubling down on growth. In the US, it's about pro-growth policies, some sledgehammer policies around tariffs, deregulation, lower taxes. And in China, it's about government intervention and pro-growth stimulus. So the prospect of synchronized US and China growth would be a major driver for this sector. And if you remember, the last time we had synchronized US and China growth was in the early to mid-2000s. And that was a fantastic period for commodity prices. And that's when China was spending trillions of dollars on infrastructure. Now we're going to be spending trillions of dollars on renewable energy and future-facing technologies. So this is really interesting where we are. We're at a historic point. Of course, Trump policies could lead to a trade war. We may not end up with peace in the Ukraine and the Middle East, and then everything's looking a bit shaky, but then we can anchor ourselves in gold. Now, the interesting thing that really has happened is Europe has finally been goaded into action. So finally now we have Germany deciding actually it needs to fix its broken infrastructure, and Europe as a whole realizes they need to spend money on aerospace and defense. So now we're seeing a prospect of Europe potentially joining the US and China in actually investing in the future. And that, again, would just add some icing to the cake in terms of commodities demand. So that's a little bit about the backdrop for broader industrial metals. I'm going to talk a bit about the new bull market for precious metals, or gold more specifically, because really where we are right now is quite profound. What we've seen is if we look at a chart of real interest rates versus gold, there's no reason to expect that gold has risen to new records over the last couple of years. if we look, similarly, if you put a chart of versus the dollar or other things, why has gold risen? On the chart on the right-hand side, the traditional driver for gold to enter into a bull market has been gold ETF inflows, particularly Western gold ETF inflows. And what you can see, they've just started to turn around. So again, there's a major disjoint here between what the gold price has done and what the traditional drivers for the gold price have been. And this is because the depth and breadth of the gold buyer pool has expanded enormously over the last 2 years, driven by central banks, but not only central banks. So what we've seen last 3 years, central banks have really stepped up their purchases of gold as a reserve asset. And it's not just been the Chinese central bank, it's been central banks from Poland to Turkey and other emerging market countries particularly that have been moving away from the dollar and moving to gold as their favored reserve asset to increase. So gold has now eclipsed the euro as a reserve asset for central banks in terms of popularity. And these emerging market central banks still have a long way to go in building up their gold reserves to the same levels that they are in many Western economies. So this central bank buying has been one factor, but not the only factor. We've seen a wave of fundamental gold buying come out in the last 2 years. These include retail investors ranging from India bullion jewelry buyers to Walmart and Costco investors in the US, high net worth investors around the world, Bitcoin billionaires taking some of their money and buying physical gold, family offices in Asia and in Europe adding to their gold holdings. And now potentially Chinese insurance companies have also been given the green light in an experiment to start adding gold as into their asset mix. And so this gold rally has happened completely without the traditional driver of gold price increases, which has been Western financial investors. So there's still more to come when those investors come to the table. And what we found in this rally, there's always a buyer at any price for gold right now. So that's why the pullbacks in the gold price on this rally have been shorter and shallower than typically you see the pullbacks in gold price evolution. A little bit about silver, because everybody's going to ask me about, well, some people might ask me about silver. So silver. So silver's really interesting right now because silver has really lagged what's happened in the gold price, okay? You know, gold is setting a new record every day. Silver's still $15 off its record price. So it's significantly lower. And some reasons for that, which I'll come into later on. But we think it's really interesting. Not only is there a catch-up trade for silver to be had as a monetary metal to gold, but also because of new technology demand. Remember that 60% of silver demand is driven by industrial use because of growth in solar panels and the growth of use in silver in electronic circuits, ranging from EVs to data centers. We see a massive supply-demand deficit opening up in silver. So by 2030, we're going to need over 1 billion ounces more silver than we do today. And to put that in context, the annual production of silver is about 1 billion ounces a year. So we're going to need to find another year's worth of silver supply between now and 2030 in order to meet these demands. The problem with silver is that the buying is very price sensitive because it's industrial based and there's been a price war in solar panels and generally slow demand, so it's been moving up very slowly relative to gold. There isn't that sort of fundamental buying pool for silver on the financial side like there is in gold. So that's why it's lagged, but shows there's an opportunity for it to catch up. So what will drive these mining equities to re-rate? So the outlook for metals and mining, there's a bit of uncertainty out there, but generally if you look in the medium to long term, it seems quite positive. So, this gives you an element. The PNAVs for the gold mining companies compared to the gold price. Look how they've lagged both historically. So why have the equities lagged? There's been a concern over the sustainability of their costs and capital discipline. And there's been a lack of interest from Western financial investors in buying gold mining equities. So central banks and family offices, they're not necessarily buying the equities, they're buying the physical metal. So the point is, but the Western investors who would typically buy the equities aren't in the market yet because they're still preoccupied with other things. So there's a catch-up trade to be had when that happens. And the other catalyst is going to be real evidence of improving financial performance amongst the gold miners. So look, what you can see is that last year we're hitting almost on record dividends and buybacks for the sector, and we expect that this year we will hit record dividends and buybacks for the sector. So shareholder returns are increasing, and that's coming from both dividends and buybacks. We also have big capital discipline here. So typically in the last 2 gold bull markets, what happened is that the gold mining companies chased the gold price upwards. They mined lower and lower quality ounces. They based their business plans on spot gold prices rather than base gold prices. And they ended up destroying shareholder value rather than making shareholder value. That's not happening now. Barrick, one of the world's leading gold mining companies, look at the gold price that it's using for its reserve price assumptions. It's very modest, below $1,500 an ounce. So their business plans, the gold mining company's business plans, are using in $1,500 an ounce lower gold price than spot gold price. And that means that's all going to shareholders and future sustainable development. Here's a chart that shows that margin expansion. This is where average all-in sustaining costs are compared to the gold price. Well, actually, this chart is already out of date, but you can see that's even a bigger margin right now. And you can see is that costs have been maintained. So that discipline is there. And we do start seeing emerging evidence of mining companies being rewarded for margin expansion. Because this is all about, will equities re-rate? There's lots of good reasons for it. One is this margin expansion. What you can see is the relationship. The companies that have the best change in margin are seeing the best change in share price. So there's a real interesting sort of supporting evidence here for that. So a little bit about performance and guidance. Last year, the companies generally met their guidance, and this year they've got very conservative forecasts going forward. So we think that the previous 2 years of catching up or missing guidance has probably gone behind the gold mining companies. A little bit for copper. So copper, the same story. Copper costs are well under control because of capital discipline and because of some good gold credits some of the copper miners are making. And the discipline is holding. So what we're seeing, we talked about the supply-demand deficit opening up. What you can see here is the copper demand rising because of all these industrial uses we've been talking about. But supply-side discipline means that supply-demand deficit is significantly opening up by 2030. So that's a little about that. And then finally on lithium. Nobody wants to talk about lithium because it's been such a bad sector for the last couple of years. But the reality is that finally, discipline is coming to the lithium sector. CapEx is being reduced, projects are being cancelled, workforces are being reduced, and now the spot lithium price for hard rock lithium is well below the all-in sustaining cost. So this suggests to me at some stage there's going to be a turn back up in the lithium sector, and it may happen sooner than perhaps people expect because energy storage solutions are really focusing very heavily on lithium right now. So there's potential demand driver that people weren't baking into their forecasts previously. So that's a little bit about the market. How do we take advantage of that? Well, we have 4 pillars to our investment approach: risk, value, inflection, and ESG. So risk, we look at the technical and geological risk. Our background lends itself to doing that. We look at the geographical risk, financial and balance sheet risk, asset concentration, and corporate risk. We look at value. We have our own in-house valuation tools for looking at valuation. We look at beta and torque, yield and buyback. Inflection is all about news flow, mergers and acquisitions, financial reports, etc. And then ESG. ESG is really important to us. I know it's not very trendy right now, ESG. Everybody's gone off ESG. But for the mining sector, it's still very important because if you do the wrong things on ESG, your mine gets taken away from you, or the locals protests, or your miners go on strike, or accidents happen that make the mine inoperable. So ESG is still critically important for us, and we're probably the leaders in ESG. In fact, we're the only Article 8+ investment funds in the sector because of our strong approach to ESG. So it's a great lens to understand corporate risk. So in portfolio construction, we look at different types of companies, different types of commodity, different country exposure, top-down factors. We maintain very liquid portfolios We manage volatility and torque. Our weightings are typically 1 to 5% and index agnostic, which means concentrated portfolios, long-only equity. Top-down factors are macro factors, so we flex both funds based on top-down factors. Particularly in the Electrum fund, we rotate between different metal exposure as well as different types of companies in order to take advantage of what's happening in global trends. Here's a chart that shows that a little bit. So what you can see is that we increased our exposure to gold over the last year, and precious metals, I should say, most of that in silver. We took profit on copper in the middle of last year, reduced our exposure there. We reduced our exposure to lithium because of the oversupply situation, and we increased and then took profit off our uranium exposure. It gives you an idea of how we flex it. And what that means is if we look at our 12-month return, this is last year's return, the basket was, the index was flat and we were up 19%. We outperformed this 19%, not just from stock picking, but getting the sector call right. The most recent sector call that we did right was when Trump got elected, we invested in US metal producers, and that trade worked out well for a period of time. And now we're looking for what the next theme is going to be, which we're deciding right now. So this is how we manage the funds, and that's how we generate, at times, quite significant outperformance relative to the sector. A little breakdown. We typically don't invest in weird and wonderful small cap, micro cap. They're too much binary risk, too much idiosyncratic risk. So if you look at our top 5 positions, typically they're well-known leading companies in the sector. We do have quite a heavy mid-cap exposure. We think the best place to find exploration and development isn't by buying a small cap company, is by buying a mid-cap company that's got a good exploration and development pipeline, because it's significantly de-risked compared to a junior. So that's kind of where we focus. Again, we're always fully invested, well diversified geographically, and really, as you can see, most of the companies invest in producers rather than developers or explorers. Very similar picture for the precious metals portfolio. Again, globally diversified, very heavy concentration to silver, and again, mainly in producing companies. I think the only thing I'll just sort of point out is the Electrum Fund also invests in precious metals mining equities, not just because we think that precious metals are key for a sustainable future. Gold is key for a sustainable financial future, and silver is key for some of the new industrial trends that are happening out there, and PGMs as well. So there's always an element of precious metals exposure in Electrum as well. So that is the presentation. I should just mention quickly my colleague and partner, Cosmo Sturge, standing at the background. He's head of market strategy. We have a little stand downstairs, so you can, if you can't get to me after this presentation, you can grab him down at the stand afterwards and ask any follow-up questions. If there are any questions, we've got a few minutes left, don't we? 6 minutes left, so I've got just enough time for some questions if people want it.
Hi, do you mind expanding also on platinum and palladium?
Yeah, sure. So I've got a microphone here. Yeah. So platinum, palladium. So yeah, look, we actually it probably got missed because I flicked to the chart quite quickly, but we had slightly increased our platinum palladium exposure over the last year. So a couple of things have been happening in platinum palladium market. I think the first is that because supply side has been relatively slow, that supply demand imbalance has got better. Some people say there's actually a fundamental deficit in platinum group metals right now. I'm not 100% sure that's quite there yet, but let's put it this way, it's quite a finely balanced market. But what's happened in platinum group metals over the last 2 years has been a surprising resilience of the growth of internal combustion engines and the use of PGMs in auto catalysts. So what's happened is that two big industrial trends have happened to create a better demand environment than people were thinking a few years ago. So for the same reason, the demand environment for lithium batteries has perhaps been grown less fast than it's still grown double digit, but less fast. Internal combustion engines have been more resilient, and that's for 2 reasons. One, thanks to Chinese manufacturing, the the cost of manufacturing an internal combustion engine has gone down significantly. So what has created a new market, elasticity of demand. So in many emerging markets, instead of buying a motorbike or a tuk-tuk or whatever it is, you can actually afford to buy a car now because the price point has come down low enough. So that created demand increase for auto catalysts. The other big trend that's happened has been the shift towards hybrids and range extended EVs compared to pure EVs. So that's been a much bigger sort of reshift back towards hybrid type vehicles than I think people had anticipated. And again, they use smaller lithium batteries, but they also have a petrol engine, so they need a catalyst that involves PGMs. So the demand environment for PGMs has been better than expected, and the supply side has been relatively flat. So the environment's looking reasonably positive right now. And then, of course, in the medium to longer term, or maybe more longer term, is the prospect of the hydrogen economy. So now what's happened is this renewed demand for internal combustion engines. It looks like it's going to bridge the gap between when the hydrogen economy is ready to take off and you need PGM catalysts to generate the hydrogen. So that's sort of a summary on that. Hopefully that's helpful. So cautiously positive, but the problem is if we get into sort of a bit of uncertain times industrially, let's say reduced auto sales in the US or whatever, that's going to have a negative impact. So shorter term, it's going to be a bit rocky, but I think medium to long term, it's looking more positive than it was 2 or 3 years ago. Yes, go this one back here, and then we'll give them one in the front here.
Thank you. What's your view on how one should position themselves in the short to medium term when comparing companies that are pure play mining companies versus companies that actually process the output from the mines? And I'm thinking specifically along the lines for uranium. So processing the output from the mines for use, let's say, in nuclear power plants versus pure play mining.
Yeah, look, I think the processing actually, in the very short term, isn't a bad place to be, because we know from speaking to utilities that's a big concern of theirs, is that conversion and upgrading and everything. So the utilities are quite concerned about that right now. They will be concerned about mining, but right now it's the processing. So in the very short term, I think it's processing. I'm not talking about that. If I put valuations aside, that's a different matter. However, ultimately, I think in the medium to long term, it's much more positively skewed towards mining. We are just going to need so much more uranium than we have now. Now, right now, it's a little bit distorted because of geopolitics and Russian, uranium bans and things like that. But the reality is the rate at which new reactors are being built or planned, not just in China, but now in Europe and potentially in the US, including the small modular reactor potential to feed, smaller things like AI data centers and things like that. The demand growth is going to be quite staggering, and that's really going to favor the mining companies. And I think it's going to favor mining companies in stable jurisdictions that give security of supply. Yeah, so I think shorter term, we know that the power generators are concerned about processing, but in the medium to long term, there's that deficit that needs to be filled. So right now, if you look at the valuation, though, uranium prices are at quite a low point, and the uranium mining companies are probably pricing in $10 higher uranium price than the spot price right now. So they're arguably, even though uranium mining shares have come off, they're still perhaps pricing in higher than spot prices, which is probably different from almost every other commodity where most of the mining company shares are pricing in lower than spot prices. So just another dimension to think about on the sector. We had one in the front here, sorry, who's next? And then, oh no, sorry, missed you. I will get. Yeah.
I had just one question. In Switzerland, you never mentioned Glencore. It was also not one of your top holdings, and you didn't mention the Chinese debt trap. So what is it? is that the reason why you're not so bullish on Glencore?
Yeah, look, well, I think that Glencore has been in the portfolio. It could be in the portfolio again. But we were right not to have that as our pick for the last few months. It's been one of the more underperforming majors. So we made a decision based on its asset mix and everything else that it wasn't the right place to be. And we picked Rio Tinto as our favorite of the companies. We felt that their share price had been under more pressure. I think both calls weren't brilliant, okay? There were better places to make money in the sector. But so look, I can't knock them. But, they are involved in commodities that have been under pressure. Coking coal prices have gone down. Cobalt prices have gone down. Nickel's gone down. So they've had some challenges in their commodity mix, and they're not very big on copper, which has been one of the more positive commodities over the last year. So, and they're not very big in iron ore, which even though it hasn't done well last year, it's actually quite a resilient commodity in terms of margins. So it's got a very different business mix from perhaps a couple of the other majors. So, but yeah. No, don't knock them. We've got the last question there, I think. I think we've got time for one more. Do we? Yeah. Oh, no, we've got one back here.
If I remember correctly, you said in the presentation that you have between 30 and 50 holdings. And the question is, I looked at the top 5 holdings, which accumulate to 25, 30 or whatever percent.
Yeah.
So you have a pretty high concentration risk. How do you take that into account? And do you have any...
look, I think...
top level maximum which you can take in a position on a single asset?
Well, I think actually it's a good question because it helped me talk a little bit about our portfolio risk management. So we choose our position sizing is not really what's in the index. It's about the risk value of that individual stock. So we typically, most positions in our portfolio are between 2 and 5%. And that sizing is based on risk factors, including liquidity and value factors. So typically stocks like you see in here are lower risk, but perhaps not as good value opportunities. And whereas maybe some of the 2 or 3% holdings might be more talky stocks, but still sort of in the mid cap range. So that's where we go. So we might have some stocks held at the sort of 1% level if we're getting into or out of a position. But typically that's the range. So yeah, that would be it. And it's 30 to 35 positions in the precious metals fund, and it's around 40 positions in the Electrum fund, just to give you an idea of that scale. I think there was another bit of your question there in terms of, but I missed it. Was there a second part to your question?
Just about mid caps, small caps, if you have a certain limitation.
Yeah, so we do.
Internally 3%.
Yeah. Oh, yeah. So look, we ultra small caps we don't invest in. That's let's say 100 million euros in terms of market cap, but our average market cap is about 5 billion in the portfolio. So really, for us to invest in a company that has got a market cap of less than 1 billion is an exception rather than the rule. And more typically, we're investing in companies 2 or 3 billion at the small end, up to multi-tens of billions at the big end. So hopefully that helps. We could theoretically, under our portfolio rules, take up to 9.99% in one stock, but we never go that far. The furthest we might go is 6% if we're riding something that's a very positive story. One more back here, as long as the organizers let me.
Great presentation, very insightful. Thank you very much. Copper and smelters. We still have most of the smelters in China. We need copper. We need lithium. We're also dependent on China for the processing of lithium. What's your geopolitical view on that?
So
and also the unreasonable, typical stupid question of the 92 today ratio silver to gold. What's your personal view on that?
Well, I'll talk about the ratio silver gold in a second, but the copper thing is really interesting. So what's happening on the copper smelters? There's actually an excess of copper smelting capacity in the world right now. So actually, the copper smelters are paying the mining companies to get concentrate to process. Well, not really, but that's what the spot TCRCs are telling you. So there's excess capacity, and that's in China. But of course, longer term, there's a strategic issue around what happens to copper smelting and refining capacity. Where is it located? Now, there's significant copper smelting and refining in the US and in Europe as well. So it's not like some of these other commodities where there's nothing outside of China. There's actually significant. And the other thing is there are some new projects, particularly being developed in the US, that are using more advanced leach technologies that could potentially mean that copper cathode can be produced. For example, I was in Arizona earlier this year visiting 4 different copper projects, 2 of which were going to produce, actually 3 of which were going to produce copper cathode on site using more sort of innovative processing technologies, not requiring the need for a smelter. So we obviously had, that's actually quite big in many parts of the world. SXEW it's called, solvent extraction electrowinning by copper. You use acid essentially to leach out the copper, but it only works in oxide and semi-oxide ores. It doesn't work in sulfide ores. But you can expand the range of ores that can work with by using technologies like fine grinding and introducing some air or oxygen into the circuit. So, and I think they're building one of the first in situ copper leaching projects in the US right now. And if that works, then that could. So I think it's an interesting one because it actually plays into geopolitics. A lot of copper growth opportunities in the US, a lot of copper cathode production opportunity in the US, and this whole geopolitical thing means that actually some of the US-centric copper stocks could be a good place to be over the next period. Yeah. On silver-gold ratio, it comes back to that. We think that the problem with silver has been the industrial buyers are very price sensitive, and what we've seen is that it goes down to $30 an ounce, industrial buyers come back in. Goes to 33, industrial buyers step out. And that's been the problem. And because the fundamental buyers of gold that have set the new gold price aren't buying silver, it's the Western financial buyers who buy silver and mining equities aren't in the market. So the traditional driver for that catch up to the ratio isn't in the market right now or just starting to come back. So those are the 2 factors why silver hasn't caught up. Good, I'm done. Thank you very much.
Finally, the mandatory risk warning. The content of this episode is for general information only and is not a recommendation to buy or sell any financial products. All information is supplied without guarantee, and this is not an investment advisory. New episodes are released every Tuesday and Thursday.